from his tweets and the audience that he built, this law firm has done over $1 billion in transactions. It's helped hundreds of people get into their first businesses.
We did roughly 2.2% of all closed M&A transactions in the state of Texas that were reported. What's amazing is the investors in the space, they're DMing me going, shut up. Why are you telling everybody about this? And everybody else is going, we're going to go to the Colorado bar and report me for being a snake oil, for misleading information. I've seen people completely cover the business price with the proceeds of the sale and leaseback.
So I'm going to start by telling a story because it's one of my favorite stories and you can't guess who it is until the end. But in 2022, a young man was having a hard time. And like many of us, he was in the middle of lockdowns trying to figure out what to do with his life. He was an attorney. He was an associate at a large law firm.
Oh my God.
And he started posting content to Twitter about deals. And at the time he was anonymous and I thought he was posting some really good content. So I messaged this anonymous person and I just was like, hey man, love the content. It's fantastic. This was back in 2022. He had, I don't know, less than 1,000 followers. So it's somewhere in the ballpark. And we stayed in touch and I watched this young man work his way up. He kept tweeting. He kept amassing more followers. Pretty soon he dropped the anon status. Then he founded a law firm. And from his tweets and the audience that he built, this law firm has done over $1 billion in transactions. It's helped hundreds of people get into their first businesses. And it's just growing more and more. I think at this point, they've got dozens of associates around the country. They are literally the preeminent law firm doing mergers and acquisitions. There's nobody who does more SMB transactions than this law firm. I want you to guess who that was. And you would be correct. It's Kevin Henderson. Kevin Henderson founded the SMB Law Group.
No, you can't, no, for sure. Shout out to Kevin. Kevin is fantastic. I do want to just clarify a couple of things. One, $1 billion in enterprise value, right? Not revenue, not $1 billion in value of businesses acquired by our clients since 2022. And that does not include busted deals. That's closed transactions. And honestly, at this point, it's probably potentially multiple billion that we've worked on. So it's been really fascinating. Preeminent law firm. Those are your words, not mine, but in SMB, right? There are amazing M&A law firms. I'm an alumni of Kirkland & Ellis. I think they're the best M&A law firm on the planet. They do the $100 million, $1 billion deals. If I was trying to do a hostile takeover of the Walt Disney Company, I'm going and hiring Kirkland & Ellis, Cravath. You're not hiring SMB Law Group. You know, there's not many people like us in lower middle market M&A, right? And I think if you flash forward a couple years, you know, I think that we will be our own thing, and there will be some competitors.
What do you mean you'll be your own thing?
Well, what's fascinating about the law is most lawyers have practices. They do not have businesses, right? We are a business. We are built like a business that you would want to acquire. Nick, that's our goal. Let's build something that is scalable, repeatable, that, you know, isn't a mile wide and an inch deep. It's built like a high quality small business, which is awesome because that's what our clients are trying to do also. They're trying to buy and build high quality small businesses. And so I feel like we relate to and receive back from our clients value like no other lawyer does. You know, most lawyers are trying to bill a few hours and then move on. That's my perspective.
Yeah, I think the other thing that's really interesting, and the reason I said the $1 billion number, and again, you've probably worked on more transactions than $1 billion. Anybody who's listening to that doesn't have context is like, I don't know if they're working on $100 million deals. That could be like one or two deals that did $1 billion in transactions. But what we're talking about is SMB space. The vast majority of your deals are $10 million or below. Fair?
Yeah, $2 to $25 million range, but our median deal is like $4 million. You know, these are people who are buying subscale businesses, but, you know, businesses that are just beginning to be valued by EBITDA, not by SDE in most cases.
How many transactions have you guys done since you started?
I don't have that number in front of me. I think it's somewhere in the couple hundred range. I think last year was like 113 and the year before that was like 93.
Well, and the reason I like your perspective is because it's not just 200 or 300 done in Florida. It's 200 or 300 done across the entire country. So you also have insights into what's going on even in different markets, or what's just going on generally amongst buyers across different markets. So the reason I say preeminent is because there is nobody doing it at your scale. There's no one who's done as many transactions as you have done. And so you've like had to systematize the deal templates, how to help buyers get in the frame of mind of what's important in structuring the deal. I know you've got some affiliation with the boot camps where you're actually getting them ready to buy the business by going through due diligence, et cetera. So like you said, you've built a business and you've actually systematized it. How many associates do you have on your team now?
We're licensed in New York, Florida, Texas, California, Colorado, Michigan, Minnesota, North Carolina, Georgia, Massachusetts, Illinois. So most of the states where people want to be. Now we have had the ability to do deals in other places as well. So we're not all 50 states licensure, but most states give you the ability under their ethics rules to participate. You know, sometimes you need supervision. Sometimes you just need to not hold yourself out or not establish a systematic precedent. So we have done deals in almost every corner of the country, which is fantastic. Associate wise, we only have a handful. We have about 15 total lawyers. We've got some contract lawyers on our team. We've got some partners. We've got some true associates. And so,
wow.
But most everybody is top 14 educated, big law trained, really experienced M&A attorneys. It's not, most of our competition or most of the people that we are doing deals opposite of are, Main Street lawyers, right? They're not M&A trained, elite educated attorneys. So it's a fascinating thing.
Tell me, this is my favorite story. Tell me the story about who the hell is Kevin Henderson.
Yeah. So, there's a part 2 to it coming too, because so Kevin Henderson, my principal partner, he's one of 2 people that I founded the firm with, along with Sam Rosati, who is also very well known in the space. Fantastic. But Kevin is in Dallas, Texas, and I worked with Kevin in my prior life. We decided to start the firm together. And in 2023, our first full year of operations, according to the Texas Law Book, Kevin worked on and closed more M&A transactions in the state of Texas than any other attorney, which includes the elite firms, includes the Kirkland & Ellis's, the Gibson, Dunn & Crutchers. Now, it's a different thing, right? Rob Little at Gibson Dunn, who's doing private equity M&A, he's doing much larger deals. Kirkland & Ellis is doing much larger deals. So that's the obviously the elephant in the room, but nonetheless, he closed more M&A transactions than anybody else. And when the Texas Law Book ran the numbers and saw the table, the guy literally was looking at it and he said out loud, one of the 2 editors, he said, "Who the hell is Kevin Henderson?" And so they wrote the article, and the article was titled, "Who the hell is Kevin Henderson?" And we had a "Who the hell is Kevin Henderson" party for him being the number 1 M&A attorney in Texas by deal count. And it's fascinating because we've continued to grow. And obviously we closed more deals in 2024 than we did in 2023. Well, the M&A market actually pulled back in aggregate deal number in 2024. I don't know. That could be that some of these lawyers on the list did more and everybody else did less, but we don't know yet, but the overall pool of closed deals got smaller, but Kevin did more.
Well, next month, it'll be a year since I started this podcast. I've had over 100 interviews. It's been a ton of fun, but I promised my wife at some point I would decide whether or not this was going to be a business or we would just continue to pay for it out of our pocket. And I'm exploring monetization, to be honest with you. There's not a ton of costs, but I do want to figure out a way to cover the editing and the packaging and the promotion costs of putting this podcast together. So I am looking for sponsors. I don't know what that looks like. If you've enjoyed this podcast and you've ever found some value and you want to sponsor, reach out to me, nick@cofounders.com, and let's get back into it.
In 2024, we did roughly, according to the numbers that we have, we did roughly 2.2% of all closed M&A transactions in the state of Texas that were reported. Obviously, there are probably many that were not reported. So,
wow.
Really cool. I mean, that's cool. I mean,
that's amazing.
Yeah. And a lot of our Kevin and I's big law background is in Dallas and Houston. It's in Texas. So a lot of the people that were on that list are our mentors and people we'd worked for.
How many of those deals did Kevin work personally, and how many of those were worked on by an associate? Did he work on all of them? Like, what did he? I don't know how it works.
Yeah, all of them. We're not a shop that brings work in and just hands it off gratuitously. Everyone that was reported, he worked on. So we don't do the thing. We don't bring it in and say, hey, it's only a $4 million deal, Nick. So it's not a big deal. So I'm just going to give it to Gary the second year and good luck, everybody. I'll be off, tweeting or whatever. That's not the case, right? Because our ethos is And why we exist is that, there's lots of good M&A attorneys for $50, $100 million deals, right? Lots of them. They're very expensive. They know M&A. There are almost none. If you look at the backgrounds, even the ones that are branded SMB and have followed in my footsteps, which, kudos to them. If you dive into their backgrounds, many of them were prosecutors or were litigators, and now they've seen the opportunity in the space. And so there's very few real M&A attorneys that are doing these deals that have M&A training. And so that's been part of our ethos that, like, Nick, if you go buy a $4 million business, $4 million business, if I go buy a $4 million business, I got little kids, like, that's a big, it's a big deal, right? Like, it's a big deal for a guy to go buy a $4 million business. Dude. And he should have counsel that is reflective of that, not a M&A attorney that, hands it off to Gary the second year and checks out, or a Main Street guy that, doesn't know M&A at all.
I think it's a bigger deal than most even traditional search funds, right? Like the traditional search fund, they're going to get out of school, they're going to raise some money, they're going to go buy a business that's doing, I don't know, at least $20 million in top line, and they're going to try to roll it up. They're not signing a personal guarantee. They're not putting their house on the line, right? So like the $4 million deal is a bigger deal personally, even though the top line revenue number doesn't necessarily reflect.
Huge deal.
Didn't they change the rules on reporting because of Kevin?
They've created new categories. So
categories.
Okay. I want to categorically say, like, and I don't know what the split is, but it's what I acknowledged in the first.
Yeah.
If you're doing $1 billion transactions, obviously us doing more $4 million deals than you did in $1 billion, those are two different things. So it makes sense, but it's cool to know that we forced them to change the categories. And shout out to the guys at the Texas Law Book. They've been fantastic. They're really nice guys. They came to the Kevin Henderson party. Truly great guys that run a great business. So
walk me through. I've never done a $100 million deal, so I don't know what those deals look like. But in my experience, from 50 million all the way down to a few 100,000, the amount of work that our attorneys do is kind of similar. I don't know about the total number of hours. It's definitely more on the bigger deals, but you still have to have the same components in every deal that you go through. How have you been able to systematize, I guess, the process? Like, is Kevin just working 120 hours a week, or how is he able to process so much deal flow?
Yeah. Well, so the premise is a little bit off. In those larger deals, and we've worked the $100 million, I've worked on multiple $1 billion deals for Amazon and Jerry Jones and folks. In those deals, you're negotiating the hell out of everything. The LOI, you're going back and forth on LOI for weeks, right? Small business, you're not doing that. You're not going back and forth as much. There is a lot of negotiation on Main Street, though, but it's different, right? And the problem is, most of the time you're opposite of sellers counsel that don't know M&A, and they come for crazy stuff. So a lot of what we've had to troubleshoot over the last couple of years is, how do you overcome them asking for, a confession of judgment, or, multiple personal guarantees, or a lease assignment, or asking that the non-compete falls away if you default on the promissory note, or on and on and on, all these little things that will kill your deal. And so actually, quick plug, we took 3 years worth of busted deal data and baked it into a new LOI template for 2025, both asset and stock. If anybody wants that's listening, just reach out. Happy to share that. It's got a lot of footnotes and qualifiers. And our goal now is to help buyers address all of those little traps for the unwary up front, so your deal is less likely to die and will close more quickly. It's a lot of little stuff like that. And also, one of the biggest issues is, you can go hire Kirkland & Ellis to do your $4 million deal, Nick. They're not well suited for the deal. They're not well suited to negotiate opposite of a family business, right? They're going to negotiate the hell out of stuff that
that doesn't matter.
It doesn't matter, and that they don't care about, right? And they're not going to have an appetite to have multiple red lines going back and forth and people dying on hills over indemnification. But also SBA debt, right? Most of the transactions are funded by SBA, and SBA is an amazing product. Everything except for the personal guarantee is an amazing product. It's very high leverage debt. It's covenant light. It's relatively easy to get in substance. The process is a nightmare, and their lawyers are going to comment on the documents and get involved in the process. We've done so much of it now that our templates, when it comes through Live Oak or one of these other banks, most of the time they go, "Oh, hey, Eric, great to see you again." And, send me the documents when they're executed. And thanks for, covering off all the SBA stuff up front.
There are SBA specific, as in the government organization, the Small Business Administration specific, but then each bank also has their interpretation or their standards and requirements that they want to have, but it has to be in the purchase agreement. Like it has to be in the deal in order for them to lend, right?
Yeah. And what happens process-wise too is that the bank does not bring in their lawyer to the 3-yard line. They're not going to take you seriously until you're very, very late. So if you have a bunch of stuff in the LOI that you can't do, and then you have a bunch of stuff in the purchase agreement that you can't do, and the seller believes that they're going to stay on for 3 years and that the note and all this different stuff, and then you get to the point where the deal becomes, everybody gets deal fatigue down the stretch. Every deal, you get to that point where they're like, what the going on? When are we going to close? Right? If you get to that stage and then the bank's lawyer comes in and goes, hey, I know you thought you were getting that working capital adjustment or that personal guarantee or this carve out to the non-compete, or that you weren't backstopping indemnity, or that you were going to stay on for 3 years in an asset deal, but you can't do that. And then you got to go back and renegotiate with the seller at that stage. That's a really bad recipe. So that's part of the secret sauce, is that we've just done this so many times now that those things they've stopped happening, or we're able to tell the buyer up front that, like, hey, listen, this is almost certainly going to be an issue. So make sure you are communicating that and foreshadowing it to the seller, so they're not blindsided by it.
Your point about you never know who the seller's counsel is across the table is so true. Although I do know every time I'm working with an attorney who's got a real estate background, because when I'm submitting the LOI and we're talking about going into due diligence, they're like, we can't do due diligence until we have a signed contract. I'm like, what are you talking? Well, we got to have the signed purchase agreement. And I'm like, oh, you're a real estate attorney, aren't you? Because like they don't move forward with any of that stuff until they've got their like signed contract, and then they go and work through all the stuff in due diligence, and there is still some back and forth. But that's always a flag for me. I'm like, oh, okay, real estate. Great. This is going to be fun.
Yeah. And they conflate inspection periods with, in earnest money deposits, and you've got this amount of time to diligence. It's just a very different thing, right? Like when you're buying a dynamic organization with people and contracts and employees and skeletons in the closet, a lot different than sending an inspector out there to spend 6 hours kind of looking at the foundation and the attic and the roof and then, making judgment calls. It's
Yeah. Last thing I'll say on that point in particular, if you're doing a deal, get an attorney who does deals. Don't get the family friend. Don't get your like I have 2 brothers who are attorneys. One's a real estate attorney and one is an entertainment attorney. They're not writing my purchase agreement. They're like, I can get counsel from them. They can give me advice, but don't go to people that you just know, like, oh, they're an attorney, they're a family office, they can go ahead and do this deal. Like get someone who has actual deal experience, because it will ruin you potentially if you don't have someone who knows what they're doing.
Yes. And I'm biased, right? But also financial diligence, right? Go hire a QOE expert who specializes in, that level of purchase price and that level of business, and 10,000, 20,000, 30, I don't give as long as they're going to identify stuff. And one of the best things that can happen in your deal is that they suss out problems in advance and your deal dies, because otherwise you're living with it for multiple years. And that's going to be a horrible, incredibly difficult thing to overcome. So, I'm biased, like asking a barber if you need a haircut. But when we talk about business buying, because people are, they're critical of business buying all the time, and they pull these statistics and yada, yada. But what I characterize it as blue chip entrepreneurship through acquisition. Entrepreneurship through acquisition is kind of the term of art in the schools and all that. But it's different than if you're going to go buy the local, Greek restaurant, and take a wild risk on a very poor quality small business and have to work it all day, every day. I mean, the buyers that we have are buying businesses that are 750,000 to 1.5 in earnings. They've got barriers to entry. They're smart businesses. They're running them through sophisticated SBA lenders that look at, thousands and thousands of deals. They're doing quality of earnings with sophisticated financial accountants, and then they're hiring, experienced transactional attorneys. And so when they're getting those deals done, the failure rate on those deals, it happens. It's entrepreneurship. I'm not going to say it doesn't happen, but it's vastly different than, compacting all this buy, sell, buying statistics into one basket and drawing conclusions.
It's true. I posted something the other day that was like, if you're doing a deal, if you're buying your first business, you need to do at least one of these 3 things. You need to hire a coach, do a boot camp, or pay for a course. I fully believe that, because you need to understand soup to nuts how the deal process works. And then I started getting some comments that were like, well, actually, you need to pay for a QFE, and actually, you need to have an attorney. It's like, that's table stakes, man. I'm not saying that's Q of E. If you don't do, like, you have to do that if you want this thing to be successful. A competent attorney, you have to do that in order for this thing to be successful. I would even pay for consultants to come in and look at your insurance, have have your attorneys come in and look at your contracts, not just writing the PSA, or the contract, but actually looking at the contracts that you have with customers. Like, spend the money up front. Otherwise, you're going to pay for it on the back end. I didn't believe that the first time that I did a deal, and I got lucky, but every deal that I've done since then, I pay the money up front.
Yeah. And some courses are better than others, but I agree with that. And what we've seen too after closing deals is we quickly realize, like, hey, papering up these deals is not enough, right? Papering up these deals is not enough. Like, our business, the reputation of our business, the health of our sector is going to depend on the success of our clients, right? And so after seeing every issue under the sun, because every deal has an issue: working capital, sellers that compete, assets that they walk off with, employee issues, key man issue, everything, insurance, every issue. We have transitioned to now being kind of that medium-term support for people post-closing, to not just, if you want to go find a piece of paper to do your deal, you can find a piece of paper to do your deal. And if you're doing like a sub-$1 million, deal, buying a $600,000 bait and tackle shop, and it blows up and you can recover, that's great. Take the risk. But if you're buying a $3 million business and you're an average person that's going to destroy decades of financial, opportunity, you got to be thinking more, how do I make sure I'm in the best possible position post-close?
So is that like a fractional in-house counsel almost offering that you guys have now?
It is. Yeah, it is. We offer all our clients a bunch of stuff post-closing to make sure that they are in a really strong position and that they have somebody to call, right? They have somebody to call. Most lawyers, you close the deal, you hang up, you call them a week later and ask for a contract, and they go, I'm sorry, who is this? Nick. Okay, Nick, we're going to need you to sign a new engagement letter. And, thank you for the phone call. I'm going to bill you for this phone call even. And it's just not in line with the ethos of kind of making sure that the client is successful in the acquisition, not just in the transaction.
All right, let's transition. I got some questions for you that I think would be really interesting for people to hear, especially from somebody who's done so many deals. Let's say I'm a first-time business buyer. What are the things that first-time business buyers screw up the most?
Well, number one, I think that first-time buyers are nervous, and they don't have that level of confidence that they should have, right? And they're very quick to lay down and acquiesce to the broker, to the seller's demands, and very quick to try to gloss over, appease, to get through. And what I tell everybody is, I'm like, listen, when you're investing multiple millions of dollars into something, you don't need to walk on eggshells. You don't need to walk on eggshells. Don't be diplomatic and be problem solver, but approach it unemotionally. And that's very hard to do.
Mm-hmm.
Elliot Hollins, once you pass LOI, it's very tough for them to be unemotional, particularly when they have the pressure of their wife saying, or our spouse saying, where are we going to live? Let's get a lease. When are we closing? Yeah. Everybody's going, when are we closing? You got a bunch of people counting on you, expecting it to happen. And so the pressure is on, but you got to lay out in advance, like you said, your table stakes of what you can and cannot live with, right? And so if they start asking you to scrap promissory notes and put down big, non-refundable earnest money deposits, or, agree to confession of judgments, things like that, you've got to be ready to walk away from that deal if that line gets crossed.
What's a confession of judgment? I don't know what that is.
Yeah. So there is a great episode of Acquiring Minds that highlights the danger of this mechanism. And so I would encourage everybody to Google that and go find that episode if you're serious about buying a business, because it's a good case study of what can happen for your business to actually fail. And in that episode, in that case study, the business failed primarily because of the confession of judgment mechanism. Other things happened, but it was the final nail in the coffin. And what a confession of judgment mechanism is, it says that in your promissory note, if you default, you are waiving your procedural rights to go to court and defend yourself. You are confessing to the judgment. So instead of the seller having to take the note and go, Nick hasn't paid me in 3 months. And when you're not paying, most of the time it's because you're going, well, I'm not paying you because there's problems, right? There's a bunch of going on. I think I have indemnity claims. I think I should have an offset. You're not supporting the transition like you're supposed to, whatever. Similar to this case study. When that confession of judgment mechanism is in the document, they can take it right to the clerk of court. They don't even have to go to court, and they can put you in default. And then when they do that, they actually leapfrog the senior lender, because the senior lender, the SBA hasn't even put you in default yet, and they can start freezing your bank accounts and basically implementing the judgment. And in that case, it was a construction business. They froze the bank accounts. They had to walk off the job site, and the business was dead right then and there. And it is illegal. It's due process. It's not even allowable in New York, Florida, California, many jurisdictions, but there are states like Virginia and Maryland and others that allow this. And sellers councils will ask for it. And if you don't know what it is, don't know to look for it, you get nailed.
Let me restate what you just said. I'm buying a business. It's $5 million. I can get the bank to lend 4 and I get the seller to finance 1. Let's just assume I don't put any money down, whatever. And so I'm paying the seller. The seller's carrying a note for me. I miss 3 months of payments. If that mechanism is there, confession of, what do I call it again?
Confession of judgment.
Confession of judgment. If that's in there, they can go to the bank, or not to the bank, they can go to the court and say, hey, they haven't paid me on my note. I want you to freeze their accounts because they owe me this money.
Yeah, they can go get the judgment at the clerk and then implement the judgment immediately.
How does that get past the SBA? I thought the SBA doesn't allow anybody to be in a senior position to them.
How SBA debt works is they have banks that lend on their behalf, and then the banks are supposed to follow the SOPs, the standard operating procedures of the SBA. And if they do, then the SBA will backstop them if the deal blows up on the back half. And the banks have lawyers that review the documents and all this, but they're not ultra sophisticated, and they look for very specific things. They look at the non-compete, they look at the indemnity, and in this case and in many cases, they'll miss it. And if you don't have a lawyer, because oftentimes what I have to do, Nick, is I have to take the crazy stuff that the seller's counsel is asking for, and I have to go to the bank and I have to go, hey, do we really want to do we really want to allow them to not backstop the note and have this carve out to the non-compete and this confession of judgment mechanism and these limitations on indemnification? Because doesn't this seem like it's going to put all of us, you and the buyer, in a very weak position post-closing? And then they go, oh yeah, you're right, Eric. And our credit committee is not comfortable with that risk. And I go, great, thank you for telling me that. And then I go back to the seller and I go, hey, talk to the bank.
It's the bank.
They're not going to go for it. But if your lawyer doesn't know that, doesn't do enough of these deals to identify that stuff, there's a good chance, like in that Acquiring Minds episode I referenced, where it will get through and you'll be in a very bad position.
Okay, so don't walk on eggshells. Be clear on your non-negotiables. What other mistakes do first-time buyers make?
Not asking for enough transition services, right? And I know that I get some pushback on this. One of my probably most useless but most important pieces of advice is buy a good business from a good person, right?
All right, now's the part of the show where I feel the most uncomfortable, but my therapist says I need to face my fears. So here we are. I've started a newsletter and I want you to subscribe. And what you're going to get every single week are the aggregated conversations from that week that I have on this podcast with an overview of what their business actually looks like. I'm also going to throw in a review of 1 or 2 businesses that are listed for sale. I'll give you my opinion on whether or not the EBITDA multiple is good, or there's customer concentration, or there's red flags or green flags. And then lastly, I'm going to give you one piece of actionable advice every single week on how to buy your first business. So click the link below, subscribe to my newsletter, and let's get back into the show.
Good business, obvious. Good person, not so obvious. In 90 to 100 days, it's hard to confirm that somebody's a good person. But in 90 to 100 days, it's pretty easy to tell if someone's not a good person, right? And if they're talk to their employees, talk to people who are around them, you'll figure it out pretty fast. You want to buy a good business from a good person, and then nothing is going to save you more than having that person around for a period of time, 3 months, 6 months, 9 months, a year, to tell you what you don't know, to help keep customers in place, to help keep employees in place, and provide that level of confidence. But buyers are reluctant to ask for that. Now, are sellers always helpful to have around? Are they always productive? No. We had one recently that, he asked him to leave immediately, because of diplomatic issues. But that's, if you can find a supportive seller on the back end. I went and met with John Mahoney, who's in Eastern Tennessee. He was expanding. He's doing fantastic. Shout out to John Mahoney. And the seller, Mr. Bailey, was there, a year later they're expanding the facility, and he was there and he said some words at the transition, and, and it's, that's great. That's great to have on your team.
Yeah.
So, buyers are reluctant to ask for that because they feel like they're, going to be asking the seller for too much.
Well, the advice I give to people when they're looking at buying a business is you've got to build a relationship with the seller. The first conversation, don't ask about price. Just ask them about them, their business. Get to know them and build a relationship, because if you can form that now, the deal is going to fall apart 2 or 3 times. There's going to be something that comes up that is emotional and intense. And if you can't pick up the phone and call the seller to at least talk it through, the odds of the deal dying go up significantly, but also post-close. I mean, with the SBA, you referenced it earlier, you can't have the seller stay on for 3 years. There's a defined period of time where the seller can actually stay on in a capacity where you're paying them. And after that, they're not supposed to be, working in the business. So you want to be able to have a good enough relationship where even after a year, you have a customer issue and you're like, hey, Brian, this guy's being a real jerk. Tell me the story with him, right? You want the seller to be collaborative with you and be invested in your success.
100%. Yeah, 100%. And if they're a good person too, it's, their business is most cases going to reflect that. It's going to be a lot more goodwill among the employees and the clients. And you're going to have a better outcome almost always.
All right. Question number 2, what are you seeing right now in the M&A market, specifically for SMBs, right? Like not up market, but just 10 million in revenue or enterprise value and below. What's it like out there?
There's a lot of activity. I've been tweeting for a few years about the silver tsunami, and people are like, it's not true. It's not happening. And Nick, it's not happening because most of these businesses aren't saleable. They're one-man bands. They'll never be sold. They should be shut down. That's true, right? But we're talking about $7 to $10 trillion, according to some estimates, of assets that need to be sold. There's a ton of opportunity in there. And even if the opportunity isn't that, Hank's HVAC business is saleable, well, when Mr. Hank shuts the door, where do all the clients go? Right? They go to the competitors. So it's a really good time to be building a business, And if you can just do the fundamentals, answer the phone, provide good service, build a real business with a real digitized reputation, people are doing extremely well. And so we're seeing asks now. We transitioned, we did a lot of M&A. We've done a lot of M&A, and now our clients are coming back to us with every need under the sun in general corporate and holding company and tax and buying new businesses and everything. So it's an inch to the starting line, it's a mile to the starting line and an inch to the second, third, fourth thing for most of these entrepreneurs. There's some failure that happens and there's a lot of struggling that happens. Struggling is pretty much the ante to play for the first couple of years. And if you're paying your debt, if you've got, if you buy a $5 million business, actually one of my favorite clients, he bought a $8.5 million business, and this January was his 2-year anniversary, and he's just always ho-hum, Nick. It's just, everything is not going well and da, 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 da. And I asked him, I go, you're paying your debt though. Like yeah, that's being paid. Everything's, fine on that front. I go, well, you're a millionaire, right? Like you are like, maybe on paper, sure. And your business is not super liquid, but you've paid off 2 years of payments towards a 10-year term for a business that's worth $8.5 million. Like you've gained over $1 million in net worth. Like it's been hard, but like, how else would you have done that? What other job would you have, So it's a fascinating thing because we're getting to the point now where we've seen a couple years of maturity in a lot of transactions, and very few people fail. Very few people crush it, right? There's very few people that have these amazing projections and they realize them. Some do in both cases, but almost everybody's grinding real hard to the right, and it's hard, but it's still an amazing proposition for almost.
What are you seeing with valuations? Because we know 2 years ago rates started going up, and that was just a thought in many people's minds. It's like, well, these valuations can't be justified anymore because the cost of borrowing becomes a lot higher. Have prices come down? Have they normalized, or is it still like crazy prices?
The thing about SBA debt is it's always placed a natural limitation on what's possible. You're never going to get more than 4.5 to 5 times through an SBA lender. And that's still an amazing proposition. And one of the things I love about our space, it initially drew me to it and has drawn many people to it, is, you're buying $1 for 4.5 to 5 times. You go buy $1 million business for 4.5 to 5 million bucks, and you're 27 and you spend 5, 6, 7 years paying off, a good portion of that debt, if not all of it. You've got $1 million cash flowing asset, right? That you've bought for 4.5 to 5 million bucks. That's pretty cool, right? And it depends on the nature of the business. Many businesses, never hit those limitations. They're 1x to 2x to 3x businesses. Most businesses are 2x to 4x, multiples. and hasn't influenced it as much as you would think.
I know in the SBA space, it's like, hey, the bank's just going to be looking at, can you cover the debt, essentially. The problem is when you start getting in the $1 million plus EBITDA range, you're now competing with some private equity funds. And they don't care about paying a 4 to 5x multiple. They look at that and they're like, well, we're rolling this up. And with the size it's going to be, we're now putting this into this platform deal. So it's not valued at 4 to 5, it's actually valued at 8 to 10. So we can pay 6 times earnings. And people like you and I who are trying to buy these businesses, we get outbid and outcompeted because they're setting the price so high, right? It's not necessarily I'm coming in and saying the price is really high. Have you seen that dynamic change at all? Because that was really hot 2 years ago when I was selling my businesses. I don't know what it's like now, though.
You're seeing a lot less of that. Private equity is a lot less active. The lower middle market is a lot less active generally. Those roll-ups of HVAC and roofing and all that, that you've heard of, have stopped, most of them. But you're right? If you're going to go buy a business, and I think the threshold's really $1.5 million in earnings, north of 2 for sure, the multiples are going to skyrocket, right? Which is a pretty cool proposition, because if you think about it, Nick, go buy a $1 million earning business, EBITDA business, for 2.5 to 4.5 times, and then grow it, right? And what happens when you get that business? You double that business and it's doubling. It's not necessarily easy, but if you can get that thing to 2.5, $3 million, all of a sudden your 2 to 4 multiple goes to 8 to 12,
and you've still got a cash flowing business. Like the example that you gave of the guy who's like, hey, you've paid off $2 million of an $8 million value business. If he grew the EBITDA of that business, well, now it's like you paid $2 million off of $8 million in debt, but now your business is worth $12 million. So you've got even more, potential equity upside that you've built because you've actually grown the business.
Right. Yeah. It's a cool proposition, and it's risky, right? And it's hard. It's hard to get through those transactions. Not everybody is going to get through convincing the broker, convincing the seller, convincing the bank, convincing the employees, convincing the customers, having that. We see a lot of people that post-closing, didn't have necessarily that backbone that they ideally would have to give everybody confidence. That's why I'm so hot on military veterans that are buyers, people that have led, right? If you're buying an accounting firm, very different than if you're buying a foundry, right? So totally. Certainly something, one of my most engaged tweets over the last couple of months was a picture of Josh Schultz doing a day one announcement at a transition of a foundry. And my question was, you want to buy a business, make sure it's the right one, because I could not stand in that room in front of those guys and be taken seriously. Now I could go to an accounting firm and probably be taken seriously, but not a foundry. And so, really important that you find the right business, but the opportunity is great. And the opportunity for investors, I have people that are calling me, no exaggeration, a new person a day, and repeated people being I had breakfast with somebody yesterday. Is like, how do I get in? How do I get in? Because the economic proposition for investors is crazy in our space.
Yeah. What does that look like? Tell me a little bit about what the structure of these deals with investors actually looks like in the SBA, because the SBA is interesting. If you've got 20% or more ownership in a deal, you have to sign a personal guarantee.
Right.
It puts a limit on, many times these investors will be like, well, I'm going to put in 100,000. I want 50% of the business, but then they're like, I don't want to, have a personal guarantee. How do the structures look, and what do the economics look like for investors in the space right now?
Yeah. So before I say this, I have to qualify, because anytime I talk about self-funded search economics, and particularly what it looks like for an investor, they're like, you're lying, you're a charlatan, you're right. I'm like, okay, fine, more for us, seriously. And I'm a lawyer. I'm not an investment banker. We're not going to talk about IRRs and the like, but I will talk about multiples and what the terms are. So when you invest in self-funded search, the market's a little wide, but in most cases, you receive a step up on your invested capital plus a preferred return. What does that mean? If you got $1 million purchase price business, okay, the buyer is going to have to, in most cases, put down 10%. There are some cases where you can put down less than 10%, but let's just use 10% for round numbers. Somebody's got to put up $100,000 to buy that $1 million business. In most cases, banks are going to ask you as the buyer to put up at least 1 to 3% of the purchase price. So 10 to 30,000 of that money has to come from the buyer. In most cases, there are exceptions to that, but in most cases, the rest can come from investors. So let's say you're an investor and you put up, just again, to use round numbers to make it simple, you put up $100,000 of the 100,000 down payment. Doesn't mean that you get 10%. Well, so a couple of things happen. Typical investments, you would say, well, I put up all the capital, so I should get 100% of the business, right? Well, no, because the searcher is taking a personal guarantee. They're going to be running the whole business. You as the LP, and this is the part that people are like, you as the LP, you're gone, right? You invest that capital in most cases, unless you're investing a lot of capital, like in this hypothetical, but most cases, if you're investing 2 to 3 to 5% of the value of that business, you're out of there, dude. And like, if it fails, they're probably not even calling you to talk about it. You probably don't even, you're off doing other things. Completely passive.
Yeah.
Completely passive in most cases, right? So you're putting up 100%.
This is the real passive income.
This is real limited.
This isn't a laundromat.
This isn't a laundromat. This is real. I've got a couple of these. I great people running these businesses. I don't ever talk to them. I see their investor updates. It's great. They're not calling me. You're running a mold remediation business. You're calling me. What am I? Yeah, I'll help you if it's a legal thing. But so you put the full 10% up, but you're not just going to take 10%, right? Because also it is risky, right? They're illiquid investments. They can go to zero. Subscale businesses carry a lot of risk. So you're going to say, I'll put up 10% of the capital, but I'm not just taking 10%. So you get a step up on that of 1.5 to 2.5 times. So if you put down the 10%, you should get 15 to 25% of the business pro rata. You also get a preferred return. So you usually get between 8 to 12%. Most of the time it's north of 10% on that invested capital until it's returned. So if you put in 100K, you're going to get paid or accrue 8 to 12% interest on an annual basis. So $8,000 to $12,000 in interest per year until it's paid back, incentivizing the sponsor, the buyer, to pay you back quickly. Once you're paid back, you get your $100,000 back plus your interest. Then you participate alongside the common. So if you get your step up, you own 15 to 25% of the business. Every time the business distributes $1 thereafter, you are receiving 15 to 25 cents of that dollar as an investor in perpetuity. Now, there are ways that puts and calls and all this to build in mechanisms to potentially sell your equity back to the business or have the business buy your equity back at some point in time. Those are negotiated and somewhat controversial. But the upshot is, if you're an investor, you can put in, a portion that's going to 1.5 to 2.5 times step up, preferred return, be paid back first, and then participate alongside that operator in perpetuity, legitimately completely passive. So it's a fantastic proposition. And the searcher is a great proposition for the buyer too, because they're keeping a hell of a lot more of that business than they would be under ordinary circumstances. So it really is
buying into a cash flowing business, and they're effectively not paying a 3 to 5x multiple. They're paying like a 1 to 2x multiple because of the step up.
That's the part. And again, I'm not a mathematician. We're not here to talk about IRRs and MOAC and all this stuff. But if the buyer is paying 2 to 4 times for that, or for those earnings, so for, they're paying $2 to $4 for every $1 that comes in, or theoretically is going to come in, and you come in and you get a 2x step up, how much are you paying? You're paying $1 to $2 for every dollar of cash that business generates. Completely passive, Nick.
I knew you were a charlatan. I freaking knew it.
When I say that out loud, those are the facts. Those are the facts. And when I say that out loud, people are like, oh, this guy. I went viral on Twitter for tweeting that out and going, hey, once you discover this, it's free. And you know what's amazing is the investors in the space. They're DMing me going, shut up. What are you talking about?
Shut up, Eric. Stop it.
Stop. Why are you telling everybody about this? And everybody else is going, I had somebody say that they were going to go to the Colorado bar and report me for being a snake, for misleading information, for tweeting out.
People are so stupid. Anyways. All right. We're going to finish up here.
Yep.
I want to know, these are rapid fire questions. All right. Your spiciest, hottest takes. One industry trend that you're seeing right now that you think is overhyped.
Stock deals. Yeah. Stock deals. People are buying equity, right? And they're buying equity partially because they think it'll be easier. And the partial buyout rules of the SBA, meaning rollover equity, which you couldn't do 2 years ago. They said you can do, but it has to be an equity deal. So we saw it balloon up. It's usually like 10 to 20%. It was like 40 to 60% of deals. And that's going to have really bad long-term implications because you're inheriting all the historical liabilities. We had one, and I won't get too specific, but guy buys business. And then within a year, a big, state government said, hey, that seller, that $1 million in revenue of that seller is from a kickback program that he was running illegally, which treble damages, yada, yada. It's all that buyer's responsibility to figure that out. It could kill your company, right?
Yeah, it doesn't matter what indemnifications you have or clawbacks you have with the seller. Like, it doesn't, because you have to then go and get it. The state's going to come to you as the legal entity.
Yeah, and hopefully it's not criminal. And, he's on a catamaran in the middle of the ocean, or he's dumped all the proceeds into his mortgage and he doesn't have the cash anymore. You're in big trouble. So
Jeez.
I really, okay. I cannot emphasize enough that you should only be buying assets unless there is a very, very good reason to buy stock. And then if you're going to buy stock or equity, then you have got to negotiate very, very aggressive protections in the contract to make sure you've got real ways to recover, supersized ways to recover if there's problems post-closing.
Okay, what do you think is the most underhyped trend that you're seeing, or thing that you're like, oh, nobody's really taking advantage of this sector or this opportunity with the SBA or this type of business, like whatever it might be? What do you think people are missing right now?
Sale and leaseback transactions. Sale and leaseback. You buy a business that also has real estate. Okay. And when you do that, you buy the real estate, but you immediately flip it to a REIT or some sort of real estate investor. And oftentimes, and we've seen one, I had one, and I'm going to screw the numbers up. So these are, these illustrate the point. I don't remember specifically, but many sellers will undervalue their real estate. And what you can do is you take that real estate, let's say you buy it for $1 million, you immediately sell it for $2 million. Well, guess what? If the business, is $1.5 million business purchase price, you just got $1.5 million business for $500K. And in some instances, and I'm not exaggerating, I've seen people completely cover the business price with the proceeds of the sale and leaseback. So if you find a seller that has real estate and they're like, I want to sell the business and I want to sell the real estate, when you're in diligence, you should be calling real estate investors, sale and leaseback experts, and asking them to value that property, because it's quite possible that you can buy it, immediately flip it, offset some of your purchase price, and get really good valuations as a result of it.
Yeah. The other thing I would add to that is many times the SBA will lump those two loans together. And so you'll get even much more favorable terms for buying the business, right? So like right now it's a 10-year amortization, 10-year term. If the business and the real estate are lumped together, then all of a sudden your amortization period goes to 20 years or even longer. I think 15 is the max. It becomes
a 504 and it's got a longer period of time. It has to be more than 51% of the value has to be real estate, but you're right. And you talk to a broker about that.
Yeah. Anyways, dude, this was fantastic. Thank you for so much for coming on.
Thanks for having me, man. You're the best. I appreciate you having me on.